Every 39 seconds, a hacker launches an attack somewhere in the world. Your data, your money, your digital life. It's all up for sale, but as the cyber threat explodes, it creates an opportunity for smart investors. Hey Bowtie Nation, Joseph Hogue here with the most requested video on the channel. You out there in the nation know cybersecurity is my top growth theme for the next decade. More than any of the hope for AI, robotics, or quantum computing, cybersecurity is the one theme that is certain to produce returns. With a 20-fold increase in the malicious programs just in the last decade and 10 million people affected in 2022 alone, cybersecurity is a $116 billion addressable market. And with AI transforming the threat landscape, making attacks even easier, the market is expected to grow to $250 billion by 2029, 21% annualized growth. Cyber attacks are growing faster than a TikTok trend, except instead of bad dance moves, you lose your life savings. Cybersecurity is the one megatrend all investors need to be buying, but here's the thing, not all cybersecurity stocks are going to benefit. Some are going to dominate their part of the market, and some are going to be left behind. That's why I wanted to detail the top 5 stocks I'm buying, 5 stocks I've already invested $215,000 and counting down to the one cybersecurity stock you need to be buying. Let's start with shares of Cloudflare Inc., ticker NET, but stick around and I'll detail how to find these and how to analyze them yourself. For each stock, I'll first walk you through the company's competitive strengths and positions in that $250 billion cybersecurity market, then show you the fundamentals and how they stack up against the other stocks. Cloudflare stands out in the space by leveraging its global network, blocking over 227 billion cyber threats every day, and using its integrated platform to consolidate services like DDoS protection, zero trust access, and cloud security. Cloudflare's serverless architecture and shared intelligence model helps it produce cost efficiency at scale, something we're going to see in its profitability next. Its global reach puts 95% of the world's internet-connected population within 50 milliseconds of a data center, low latency critical for that cybersecurity response time. Looking here at the fundamentals, you're going to see the 7 pure-play cybersecurity stocks I follow, from the $124 billion giant Palo Alto to $6 billion upstart Sentinel, and this is where you should be focusing on this mega trend. While other megatech companies like Amazon and Microsoft all have their own cybersecurity products, revenue from that segment is dwarfed by everything else they do. Instead, it's in these pure-play stocks that are going to benefit the most from the trend. These stocks are cybersecurity all day, every day, and all they do is ride that exploding demand higher. And when looking at the fundamentals to compare these stocks, there are 3 factors I'm focusing on immediately: revenue growth, operating margin or profitability, and valuation in that price to earnings ratio. Later, I'll show you how I found these 3 measures and why each is so important. But I want to stay with Cloudflare here with its 26% annual revenue growth, the second highest on the list, with sales expected to reach $2.6 billion through 2026. And now that would normally make the stock a bigger buy for me were it not for these other 2 factors. First, the company is spending so heavily on growth that its profitability is the second worst, a negative 9.3%, booking a loss of $154 million in operating income on $1.6 billion in sales over the last year. Now understand, there is a difference between GAAP accounting standards, which is what's reported here, and the actual non-GAAP profits booked. For example, Cloudflare reported that $154 million loss on its operating income, but actually made about $230 million, or about 75 cents a share when adjusting for depreciation and other items. I don't want to go all numbers nerd on you, so we won't go into the detail here. Just know that we're comparing the stocks on the same basis. Besides that lower profitability though, Cloudflare is also one of the most expensive on the list at 194 times on a price to earnings ratio. But also when we adjust it for valuation, that 17% annual earnings growth, so the price to earnings to growth ratio, still more than twice as expensive as some of the others on this list. So while that revenue growth is the most important factor here, overall Cloudflare just barely makes that list of top 5 cybersecurity stocks. Now my $173 price target for the shares is based on a forecast of $2.6 billion in 2026 revenue on a 22 times price to sales average over the last year for about a 17% upside. And here I realize that price to earnings ratio on these stocks can scare off a lot of investors. Hell, I know I avoided the group for years because I always thought they were just too expensive, but folks, for this kind of growth, with sales up 20 and 30% a year for decades plus, these stocks are always going to trade at a premium and look expensive. It's something I had to get over, adjusting those valuations for growth to see that they really weren't that expensive. And I'm up 43% on my biggest cybersecurity holding, a profit of $36,000 that I'm going to show you later. Next on our list, the largest company at $126 billion market cap, Palo Alto Networks, ticker PANW, a stock in my portfolio with 200 shares worth over $38,000 and up 20% so far. Palo Alto leads in its platformization approach, using its scope to consolidate security solutions into a unified product, an all-in-one player. Palo Alto is like the Costco of cybersecurity. Buy in bulk, all in one place, and never have to worry about running out of that 72 pounds of cheese. The company is also trying to lean into the emerging threat and opportunities in AI with its AI-powered firewalls to real-time cloud security through its Cortex Cloud, driving a 100% detection score in the MITRE's latest test. Now, revenue growth at Palo Alto is the problem here, the third lowest at just 14.6%, but it's also a function of the size advantage the company has, a $125 billion company with sales expected to reach $10.5 billion through the next year. That is a full third of the total market revenue booked by these 5 cyber players on the list, a commanding lead that provides an advantage in pricing and scope. That helps drive efficiency with the second highest operating margin, and shares here are also the second cheapest at just 5 times when adjusting that PE ratio for its 13% growth. So here, this is kind of the inverse of what we saw with Cloudflare. Here, the growth is a disappointment in comparison, but those other fundamentals should put Palo Alto on your list of stocks to watch, and is why I own it. My price target of $241 per share is based on $10.5 billion in expected 2026 revenue, times a 15 times price-to-sales ratio for a 26% upside. One of the most well-run companies on the list, Fortinet Inc., ticker FTNT, with shares up 57% in the last year alone. The trend to networking and security convergence is working in Fortinet's favor with its focus, and a trend that it estimates will surpass traditional networking for a $50 billion opportunity. The company leads in this segment with the highest number of customers and volume of firewall shipments among its competitors, along with proprietary hardware to accelerate ASIC-powered security and SD-WAN solutions. With networking positioned as the next big boom in that AI and data center build-out, I think this positioning is going to drive surprisingly higher sales for Fortinet, and with its industry-leading profitability, higher earnings as well. And because Fortinet is another one here where I have to bend my focus on growth because the other fundamentals are just too compelling. At expected revenue growth of just 13% over the 2 years through 2026 to sales of $7.6 billion, it's the second slowest on the list. But Fortinet is a profit machine, converting 30% of its sales into operating profits. That is 3 times better than even Palo Alto and hints to a competitive advantage in its operations and management. While earnings are only expected to grow at a 9% pace over the 2 years, the shares are starting at a PE ratio that is the cheapest on the list. So combining Fortinet's profitability with the valuation, I think this one is the most stable and dependable on the list. Here, my price target of $134 per share is based on 2026 revenue of $7.6 billion times a 14 times price-to-sales multiple for a 22% upside from here. We've still got the best 2 cybersecurities to buy, 2 in which I've got over $177,000 invested, and the one I'm buying above all the rest. But you know, this channel isn't just about dropping a list of stocks in your lap and saying, go buy these. Give me 3 minutes and I'm going to show you how to do this analysis on your own, how to be a better investor, and how to pick better stocks. We're starting here with a long-term mega-trend theme, cybersecurity, where AI-driven cyber attacks are growing 10 times faster than the legacy attacks, according to McKinsey, and 77% of businesses plan to boost their cybersecurity spending over the next 5 years. Those of you out there in the nation know this big picture idea is where I like to start investing. Even with over a decade as a professional equity analyst, picking individual stocks is tough work. So instead, I always want to start with that bigger, longer-term theme that is going to drive all the stocks in that theme higher. That way, even if I don't have the very best in the group, I'm still going to make a lot of money as they all run higher. Once you've found that growth theme, then you drill down into the pure play stocks within it. Then for my first pass fundamental analysis that we're looking at in this video, I like to compare those stocks on the revenue growth, operating margin, and the valuation. Of course, revenue growth is the most important of the 3 because it's what drives investor sentiment, and that's what drives short-term price in a bull market. Now, a company that can grow revenue by 20 or 30% a year consistently, it's going to see its stock run higher well after the stock has become expensive on a valuation basis, and even in the face of lackluster profitability. For revenue growth here, I'm using the 2-year annualized growth expected by analysts seen here in the Analysis tab on Yahoo Finance. For example, in Palo Alto, we see among 53 analysts covering the stock the forecast for 2026 revenue of $10.5 billion against 2024 revenue of $8 billion. So if we divide the 2, we get revenue growth of 31% over the 2 years, or just under 15% on that annualized pace. Now here you could also use the past revenue growth from the income statement like we've done before on the channel. I'm using forecasted growth here because I want to get a sense of which stocks in the group are expected to continue growing that revenue the fastest. You can measure this either way here. Just make sure you do it all the same for all the stocks you're comparing. That's going to show you the growth stocks even within that growth theme, the companies that may be taking market share with a competitive advantage. But you also don't want to totally ignore that profitability or the valuation. Operating margin is the core profitability measure of a company and can be a sign of more effective management at one company versus the next. Here in the Financials tab, we find the income statement for Palo Alto. For that operating margin or the profitability here, we find the operating income, which was $942 million over the last 12-month period. Divide that by the total revenue or sales of $8.5 million, showing us that management is converting roughly 11% of revenue into operating profits. And finally, before we get back to our list of stocks, a great investment is only great at the right price. Of course, in the bull market, all of these stocks have gotten ridiculously expensive, but by adjusting for how fast they're growing, we can find the relatively cheap among them. For that basic price to earnings ratio, we're going to go back to the analysis tab, and we have that stock price of 189 shares for Palo Alto Networks, and divide by the earnings booked of $2.84 over the last year. We see here that investors are paying $66 for every dollar of profits generated by the company, a 66 times price to earnings ratio. And yes, that is terrifically expensive, but we can adjust it for how fast profits are growing to get a truer picture. A high PE ratio alone doesn't mean a stock is overpriced. If its earnings are growing fast enough, it can quickly become a great deal. So here we have the 2026 earnings forecast of $3.64 per share divided by the 2024 profit of $2.84 a share for 28% earnings growth over the 2 years, or about a 13% on an annualized basis. So if we divide that P ratio of 66 divided by 13, so that percentage growth as a whole number, we get a price to earnings to growth ratio of 5 times. I know it's a hell of a lot more work than just letting some YouTuber pick your stocks, but folks, you need to be able to do this yourself. If nothing else, just you need to be able to double check the stocks YouTubers are recommending, because from what I've seen, 99% of the so-called investing experts here on YouTube aren't even doing this much analysis. One of my favorites here on the list, Zscaler, ticker ZS, and while the shares have lagged over the last year, I'm up 13% on my position of 300 shares through strategic buying on the dips. What got me interested in Zscaler years ago was its disruption in the old school model of firewalls and VPNs into a zero-trust exchange architecture delivered through the cloud. That first-mover disruptor advantage drove its initial growth, and now it's leveraging AI to process over 400 billion transactions a day, giving it real-time threat intelligence. And here, one deal I've been watching that I don't think is reflected in revenue yet is Zscaler's partnership with CrowdStrike last year to integrate the company's zero-trust architecture into CrowdStrike's Falcon software. I think that partnership drives stronger growth than the market realizes yet, so some potential for a surprise upside there. Surprisingly, Zscaler doesn't make the top 3 in any of the fundamentals I'm looking at, but does show how the deeper research into a company's competitive strengths can overrule some of these numbers. That said, ZS does have a solid 21% annual growth to almost $3.2 billion, which puts it barely out of that top 3, and a relatively good operating margin that should turn positive even on a GAAP basis over the next year or two. Here, the market is only expecting a 6% pace of earnings growth, which I think is hugely underestimated, so that adjusted PE ratio is probably more favorable than it appears. I think that strength in Zero Trust Exchange and the partnership with CrowdStrike propels its revenue to $3.3 billion in 2026 for my price target of $278 a share on a 13x price-to-sales basis and a 42% upside. I'm going to show you my top stock to buy next, and while cybersecurity is my favorite long-term growth theme, there's another group of stocks growing even faster. In fact, I just finished the video linked in the corner here following a $104 billion buy signal into 5 stocks. Amazon alone could be pouring billions of dollars into these stocks, so make sure you check that out next. And my top pick for cybersecurity stocks, my largest holding in CrowdStrike Holdings, ticker CRWD, with 300 shares worth over $119,000, a position up 43% for a $36,000 profit. I started buying CrowdStrike after the massive outage last year when researching the company found that its Falcon platform is the best available for enterprise protection. Its AI-native security is driving a 27% annual rate in annual recurring revenue, subscription revenue that is extremely sticky and just keeps on growing. CrowdStrike is leading in that kind of AI-powered cybersecurity that I think is going to be the next evolution in this theme, with those detection speeds fast enough to stop those AI-driven threats. Not only does CrowdStrike dominate the market with its Falcon platform, but the fundamentals here make it my favorite among the group. Revenue is forecast to $4.8 billion next year and could go even higher than that 25% annual rate as cybersecurity spending ramps up against those AI threats. CrowdStrike is also on the verge of GAAP profitability, which is impressive considering it's also growing so fast. Shares are extremely expensive though on a price to earnings basis, but with those earnings expected to grow over 19% pace over those 2 years, the adjusted valuation makes this one an excellent deal. Shares did drop about 6% on its most recent earnings, and while everyone was quick to blame that outage from last July, it's really just a part of this growth story. Beating estimates for sales and earnings last quarter, management guided to nearly $5 billion in full-year sales, which is what analysts expected here, but then earnings of about $3.40 a share versus expectations for $4.42 a share. And you're going to see this in growth stocks a lot, where they're going to disappoint on earnings off and on while still keeping up that growth. And it's because they're spending more heavily to keep that growth trajectory. As long as they can keep those sales growing though, it's going to keep that stock price moving higher. My price target of $500 a share is based on a forecast of $5 billion in sales times a slightly more conservative 25 times price to sales ratio. It's a solid 29% return, and while lower than Zscaler's upside, CrowdStrike will continue to push its market leadership. Click on the video to the right to see those 5 stocks and the $104 billion buy signal. Buy these before Amazon invests billions into the companies. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.